break and talk to senior economist, capital economics, Paul Dales joins us live from Toronto. Mr. Dales, thanks very much for agreeing to speak to us. So we were hearing there from our reporter in New York, Julie Hyman. We got a better than expected number, didn't we? 117,000 jobs, and actually a little bit of a tick down in the overall unemployment rate, very slightly to 9.1%. What are you focusing on with these figures?
Well, I think in the near term they will go some way to reducing fears of another recession in the United States. But the bigger picture really is that 2 years on after the recession ended, the labour market really hasn't recovered much at all. And at Capital Economics, we don't think that's going to change. We think the labour market will remain weak, both throughout this year and probably next year too.
If we look at the details of this latest report, you have private sector employment growth at 154,000. I mean, would you describe that as being fairly decent given the predictions were for 113,000?
Well, it's certainly decent compared to what we saw in the previous 2 months when payrolls employment was rising by around 50 to 75,000 a month. So things are a little bit better. But you've really got to think that we need to see payroll growth of 200 plus on a consistent basis to bring the unemployment rate down from over 9%. And we're not really getting that. And as we look forward, I think there is going to be a bigger drag from the government sector as the US moves towards a period of fiscal consolidation. I mean, that's what was certainly highlighted by the debt ceiling deal that was signed into law on Monday.
So from what you're saying, you expect, well, pretty weak jobs growth throughout this year. I mean, what are you thinking then in terms of the overall unemployment rate throughout this year, next year? Could we see something above 9.5%?
Well, I don't think it's going to rise much further, if at all, really. I think the bigger issue is how far and how fast it will fall. For example, the Federal Reserve is hoping that in a few years' time it will be back to around 5.5% or 6%. At Capital Economics, we don't think that's going to happen. I think it'll edge lower, maybe to around 8% next year if we're lucky, but that'll be about it. And frankly, that's still twice as high as before the recession started.
So what does this mean? It doesn't do anything to ease fears that the US may be heading towards another recession. What are the prospects of a double dip at this point?
Oh, well, I think the actual probability of a double dip recession is still fairly low. Usually double dips are only created by policy mistakes, such as the Federal Reserve raising interest rates too early or fiscal policy being significantly tightened too early. And that's not really happened. But I think the bigger picture is that even if we manage to avoid one or more quarter of negative growth, economic growth overall is really not going to be very strong. We're talking about economic growth of around 2% being continued into next year, which frankly 3 years after the recession ended would be remarkably disappointing.
And I suppose weaker growth adds pressure on the Federal Reserve. What are your expectations for their next policy meeting, especially at a time where inflation is rising? So you've got weak growth, rising inflation. What do they do now?
Well, the situation now is strikingly similar to that seen last year, which actually resulted in the Fed launching its second round of quantitative easing, often called QE2. So there probably will be some hopes that the Fed will provide some kind of hint that a third round of quantitative easing is in the pipeline when it meets on Tuesday. However, the big difference between now and this time last year is the inflation environment. This time last year, inflation on the core measure was around 1% and falling, but now it's 1.6% and rising. Now, I think that will mean that the Fed really won't do anything in the near term to support the economy. Although, if we're right at Capital Economics in thinking that inflation will fall back next year, and if the economy remains weak, then maybe QE3 could come onto the table sometime next year.